So we're working on papers 3 and 4, really, really important paper. Someone's going to come in at 5 to talk to you all, Dr. Agrawal, on a graduate program. So want to get as far as we can on this, get you ready for paper 3. So last class, we covered the risk-free rate on the capital asset pricing model. That's really, really straightforward. Now we're talking about the market risk premium. And I'm saying you're going to use the implied approach last class. We said there are other approaches out there. When I started my career, everybody was using the historical approach. There are other approaches out there, but the implied approach is really taken over. It's the most common approach and essentially assumes there's no place to go get the required return on stocks. That doesn't exist. But we know what we can come up with an expected return on stocks, and we'll assume those two equal. Otherwise, people wouldn't buy stocks or would overbuy stocks until they became equal again. The paper I saw that got me convinced this approach was an article from Barclays very, very long time ago. I don't know what year, and yeah, over 20 years ago. But this is what changed it. And essentially what they said is the expected return on stocks, very similar to what we said in class. They said it's the dividend yield plus earnings growth. Exactly what we said. They say income growth. I said yield. We'll talk about what they meant by income growth. And then nominal earnings growth, which means that includes inflation. They talk about repricing. Repricing is very speculative. That's where PE ratios go up or down. That's completely unreliable. But it's these two components. They then break these two components into other pieces. They say the income part is the dividend yield plus stock buybacks or minus stock issuance. We'll talk about, I'm going to show you an article where you can use that. I do recommend you make that adjustment, but I'm just going to give you the number so you don't have to research it because the article I have is pretty old. But as old as it is, I've rechecked the numbers and it's still true today. And what this means is firms used to return cash to their stockholders by paying dividends, but today they actually do more stock buybacks than they pay dividends. For the longest time, firms issued more stocks than they bought back. But today, in the last 15 years, and even at the time this article was written, it was starting to shift where you're seeing that. So you got to make that adjustment. So it gets a little tricky when you're buying stock back. That's not cash going to stockholders. It's only going back to the stockholders who sell their stock to the company. But what happens when a firm buys a stock back? What impact does that have? Why do firms buy their stock back? But how? Yeah, I mean, it has management sees it's valuable. How is it valuable? Why would they do that instead? I mean, it's a tricky question from your accounting. So if you buy the stock back, you lost cash, so you can't invest the cash in the company, so it's going to hurt growth. So how does it impact the value? Well, what happens to earnings per share? It's going to go up. Why? Because the number of shares is going down. So the growth in earnings per share is faster than growth in earnings. And you can actually see that. You can pull, I've done this. You can pull earnings out of Bloomberg. You can pull earnings per share out of Bloomberg, and earnings per share grow faster than earnings. Why? Because companies are buying all these stock back. In the past, they were issuing more stock than they were buying back. So earnings per share actually grew more slowly than earnings. But now it's the other way around. So it's a little tricky because I have this under the income point part, but it actually gets really reflected in growth. But we're going to count it as part of the income part. All right. So it's a little bit tricky, but yeah, it does improve. Management loves it, right? Because you can talk about how fast your earnings are growing. What did y'all talk about in paper 2? It was earnings per share growth, right? That was your main focus, which that's going to be impacted by stock buybacks. They break earnings growth between inflation and real. We're just putting all together in one big number. And then the stock buybacks, I mean, the repricing, just ignore that. Then this paper goes in history of all that. Here's the historical. Stocks have returned 10.7% during this period of time. Almost, I mean, well over a third of that has been income return. That's no longer true today. It's a little bit lower than that today. Inflation has been about 3%. Real earnings growth has only been 1.7. Pretty. I mean, that means actual earnings growth during the time they wrote this was only 4.8%. But they wrote this right after a major financial crisis, so it's pretty volatile. And then repricing was 1.5%, and that is because PE ratios had risen, and that's something you can't rely on in the future. And then what this paper does, which is really interesting, it goes through each one of these pieces to tell you what you could expect going forward. So that part of the paper is out of date, but it's still useful. You can look at their history and get into it. So it's still a helpful paper. So that's out there on Blackboard, on Canvas. They have supposedly updated this paper. I can't find their updated version. I've tried finding these two guys. I don't even know if they're both still around. He looks like he could be retired. If that was him 25 years ago, he might be retired today. So who knows? But it was a good paper. I really liked it. And it did have a pretty big impact. As far as the buyback yield, this is another old paper about 8 years ago. It's a Roger Ibbotson paper, which Robert Ibbotson, he is the guru on market risk premium. That's his thing. He has a company called Ibbotson and Associates. I've met him a couple of times. He has some podcasts out there. He's a really smart guy. But this is his thing. I don't know if he wrote this paper or this guy wrote the paper and got him to sign on to it. If you get his name on your paper, you're in good shape. But it goes through what's happened with dividend yields versus stock buybacks. And you can see right here, here's the dividend yield, and here's the buyback yield. And you can see the buyback yield is growing and getting larger. And it stayed, even though this is 8 years old, it stayed up there. Firms are still buying back more stocks than issuing. You have to be real careful. It's not just the stocks they buy back, it's the stocks they buy back minus what they issue. And the issue includes stock options to employees and the management and all that. So you got to make all those adjustments. So it's actually a pretty difficult number to calculate. But they come up with a number on the stock buyback of about 1.5%, and that's what you should use. Dividend yields are about 1.5%. Stock buybacks are 1.5%. So the income yield is about 3%. So you can use that in your paper. You don't have to justify the buyback yield. You can just say, according to our discussion in class, that buyback yield is about 1.5%. Why do I want you to add that in? Because if you don't, you're going to get a discount rate that's just going to give you really horrible valuations. You're going to get valuations that are just really way too high, or else they're going to be negative numbers because your growth rate is going to be bigger than your discount rate. Especially if you pick the value of firm that has a low beta, you're going to end up with a discount rate that's just going to be too low, and you won't be able to handle that. So I'm going to recommend you add that in there. And so when we say the expected return on stocks is dividend yields, we're going to add back a buyback yield plus expected earnings. All right, so we're going to actually do that. So how do we get the expected return on stocks? We need a dividend yield. Get that from Yahoo Finance yield on SPY. Do the buyback yield. I'm just telling you that's 1.5%. That gives us the yield. And we had expected earnings growth. And we're going to tie that to expected economic growth, which is going to be productivity growth, labor growth, and inflation. And that's going to give you expected earnings growth. And this number, expected earnings growth, you're going to need it for paper 3 to come up with your discount rate. And you'll probably refer to it again in paper 4 to get your long-term growth rate for your firm. So you'll have double duty for these numbers. All right, let's start with the dividend yield. That's the easiest one. Well, the second easiest one. Buyback yield is the easiest. Dividend yield, we just go to Yahoo Finance. We just look for the SPY, which is the S&P 500 and an ETF. And we get its current yield. And its current yield, right? Wow, look at that. It's 1.28%. Really, really low right now. Remember, historically, that was 4.4% at the time the Barclays wrote their article. So that's down dramatically. But the dividend yield is being increased by the buyback yield. So the current yield today is 2.78% versus the number they were using, 4.4%. Questions on that? So productivity, these are all your forecasts, but I do have some help. So here's where you can bring in these charts from the class notes. So chart 1 is evidence corporate earnings grow in line with U.S. economic growth. So you should hopefully remember this from the exam, question 1. The green line is economic growth and the red line is corporate earnings growth. You can see corporate earnings growth has been about 6.1%, GDP growth about 6.4%. So they're comparable numbers. So you can use that first as just evidence. And then the second chart, the components of economic growth. There you've got productivity, labor, and inflation. So you got the 3 components. And so what are you going to do going forward? So how could you handle going forward? I might add some extra charts here. So for me, for productivity, if you look at it first, the history, our best decade ever was 3%. That's coming out of World War II. We have all these GI bills and everybody going to college for the first time. We were pretty low last decade, down to 1%. So you're going to have to argue this. I would probably use around 2%. You got to come with your own number. Below 1% would be pretty radically negative. Above 2%, what are you saying? So above 2%, you're going to make some argument that AI is probably going to take over. Some new energy technology is going to take off. There's something that's going to drive robotics. So who knows what's going to drive productivity growth? It has been weak this last decade for some strange reason. So if you're going to go higher, have some reason for going higher. If you can go lower, if you're pessimistic, be careful you don't go too low because it's going to make paper 4 really, really difficult. So I would definitely don't go below 1. I wouldn't go above 3. I think even below 1.5 is going to cause you issues. Labor growth, again, it's your forecast. So when you look at these, you can do Fred productivity. And Fred will give you these numbers. So if you want to do a chart like that in your paper to show, COVID really messes these up. That number is completely fictitious, but you can look at the numbers and just see it's been very volatile, but you can kind of tell from this chart that it's come down. One thing I like to do better than that Yeah, let me download it. It's kind of what I did in the graph. So it's too noisy when it's quarterly like that. So I might do like a 5-year average. 5 times, so 20. I don't even know if average would work because 2020 so messes it up. But if you can find some way to smooth it out so it's not so lumpy, you can get a little bit better sense of it. But here's the 2% that I'm using. You can see it's been rafting around the 2%. But you can probably put a chart in there to make it look a little bit more easy to read, so it's not just so noisy. You obviously have to add some data points. I don't know if this will give me a year or not, but hopefully. Make sure you format your graphs. Don't put messy charts in there. Something like that. You can see over time, and that gives you some basis. It's not that different than my chart. I did 10 years, so I'm doing decades. I like you doing this because you got to get in the habit of finding the data and making graphs real quickly. So Fred is really, really useful. You're paying for it already. The advantage of using the Fred chart is it does put the recessions in there, which is kind of nice. So you could put this into your paper. I think it's just a little bit on the noisy side. You'll notice two things. First, the average level has come down, but the volatility has also come down. Productivity used to be a lot more volatile, mainly because we used to be manufacturing and now we're service, and service is just not as volatile on a productivity basis as manufacturing was. So yeah, it used to be, especially in the recession, just all over the place. Then you get the labor. Labor is a tough one. You can see labor has been in that kind of 1% range, except for in 2000, 2010, it was actually negative. I tend to think 1% of labor, although I think that's kind of high. So what are your issues on labor? Well, population growth is coming down. Baby boomers are retiring. You do have the baby boom echo. Those people are coming around. That's kind of people about 20 years younger than I am, 15 years younger than I am. You have immigration issues. That's obviously going to be an issue. You know, if we deport 10 million people, that's probably going to have an impact on our labor growth. So you have some issues there you can certainly discuss. I wouldn't go negative, even with baby boomers retiring. We'll more than likely have people coming into the country from Latin America and South America. I mean, from Central and South America, and probably from Europe and Africa as well. No matter what, I mean, firms are going to have to hire people, so they'll do something. One thing I've seen some students do is beef up productivity. Maybe that's 3% and labor growth is 0. Essentially saying, yeah, we're having baby boomers, they're going out of business, but AI and robotics are going to replace workers. So we don't need as many workers. We're going to replace them with technology. You could certainly make that kind of argument, but that's, you know, your forecast there. Labor growth is a little bit harder to do with a Fred chart, but you can do it. You can do Fred jobs. And here, same thing, you can edit it and make it year up percentage change from a year ago. And you can download that. And you can kind of do the same thing I just did with productivity, except for this one's monthly. So if we want to do 5-year averages, that'd be 60. Yeah, like that. You spell everything correctly. When you have negative numbers, I always move the graph. I wish Bill Gates would make this the default, but I always put the labels low. I don't know why his default is. I have it right in the middle of the graph for some reason. But there you can see, wow, my word, why did you do that? Why did you think I wanted 4 decimals? So you can definitely see the decline, and here you can see there's the 1%. We've been rolling around the 1%, so that's why 1% can kind of seem like a normal number. So create your own charts very quickly. So Fred's probably the fastest way to do it. I don't know why Bill Gates is doing that. Yeah. And inflation, it's your forecast. The Fed's saying they're targeting 2%. So I think you could certainly go with that. You'd probably need a quote from Jerome Powell or someone to support that. Be careful here that you don't go to Fred and look at recent inflation, because we're not talking inflation next 5 years. We're talking inflation over the next 50 to 100 years. So just because inflation is elevated now doesn't mean you use really, really high inflation right now. So your forecast, maybe a Powell quote, something to support that. When we get all that, we assume earnings are going to grow about 5%. To me, reasonable is 4 to 6%. You get below 4%, you're going to get really horrible valuations. You won't ever buy stocks again. If you get above 6%, you're kind of out there in no man. I mean, how would you get this up to 6? Productivity, you have to really take off, but we talked about that earlier. AI is big, robotics is big, but nothing's as big as getting electricity, getting cars, getting planes. We've had some really, really high productivity in the past. It's hard to say AI is going to be that world-changing productivity versus what we saw in the 60s, 70s, 80s with computers and internet. So it's world-changing, but we've had world-changing, and productivity still has range in that 1 to 3% range. So I don't know how you get labor growth much higher than 1%, especially with so many people retiring. You'd have to have, and the problem with immigration is that most of the world is having fewer babies. It's not just the US. There is higher population growth in Africa and Latin America than in the US, but they're coming down to not even replacing their populations. So population growth is slowing down. So it's really hard to get that much more labor. If you play between these two, you probably won't get much off of 3% off of those. If you look historically, those two together have averaged 4%, but I don't think you can get 4% going forward, especially on labor growth. Remember that 4% includes women going from being a low percentage of the workforce to being heavy into the workforce. You're not going to get that happening again unless we go back to child labor or something. So, you're kind of running out of people to work. So you're kind of stuck with population growth ultimately, and especially with baby boomers aging. So I don't think you can get out of the 4 to 6% range. And I know if you're outside that range, you'll get really bad valuations. So I would go outside that range. So that gives me an expected return on stocks of a dividend yield of 278 plus earnings growth. And here, reasonable is probably in the 7 to 9% range. Maybe 6. 6 is pretty low, but if you're getting something below 6, or above 9, you're really out of whack. I know Dave Ramsey talks about stocks making 13%, but he doesn't know what he's talking about. He's a budgeting person. He's not an investor. He knows nothing about investing, so he's making stuff up. So I wouldn't listen to him. That's just crazy for him to say stocks can make 13%. That's just, I mean, how would you get that with what we have to work with here? It's just not going to happen. Even historically, they haven't made that much. And certainly historically, we got so much more from the dividend yield. It's, you just can't get that combination. Make sure on your paper, so this part of your paper, hopefully you're taking good notes and not, distracted. This is really important that you get this really clear in your mind, not just for this paper, but for your career in finance. What we're talking about here is the implied approach, the expected return on stocks. And we're breaking that into these two pieces, the dividend yield and expected earnings growth, and we're tying that to economic growth. So make sure your paper explains all of that, makes it really clear what you're doing in the paper, that you're doing piece by piece by piece, and making it really, really clear. I'll show you some example papers, but I won't put them out there on Blackboard, on Canvas, because students will just copy what previous students have done. You got to write your own thing. All right, questions on that? So what does that make the market risk premium? It equals the expected return from stocks minus the risk-free rate. So the expected return stocks we just did. The risk-free rate we did last class. It was 4.4 and it's a little lower than that today. Bonds rallied today. So that gives you a market risk premium. $3.38. Here, reasonable is 3 to 6%. If you want to double check on this, and even you can put Demodorant into your paper, he's somewhat of the expert on this. You look at his spreadsheets. It's in here somewhere. Implied ERP by month for previous months, 2008 to current. So he's using 461. He has a 424 treasury, so that's a few weeks ago. Historical ERP. Yeah, he's doing very similar to what we're doing, very similar process. There's his expected return. He's using 885. That's at that other upper edge of what I was talking about. I said 6 to 9. He's at the upper edge. So that's why he's getting a higher growth rate. But he's he's about 100 basis points higher than I am, but not way off the chart. He's not using like 8% ERP or 2%. So he's in that range. So he's about 440. I'm at 338. Where would I be different? I'm not sure exactly where he's getting. Part of it is his risk-free rate's 420, so that gives you 20 basis points. That's a fifth of it. So I don't know where on his expected return. I haven't looked at his expected return numbers, where he's getting exactly those numbers. Expected growth rate. 920. I don't know where he's getting that number, but anyway. You'd have to read his papers, but he's a guru. He's going to be somewhat in the range of what we're doing. So that gives you your second number. So that's good. You got 2 out of the 3 for paper 3. What's the last number we need? Beta. And if you took my business finance class, you did beta, right? So you've already done that. So there's 4 steps. Anybody remember the 4 steps? All right, so type of company. So cyclical. Good. What's the second one? Historical. All right, that's the 4th one. The 2 and 3 are related to each other. I mean, they have the same word in it. Starts with an L. Operating leverage and financial leverage. So you're going to write this in your paper. You'll probably have a section for each one of these. So say now that I've got, and one thing really important, remember on the market risk premium, you never mention your company. It has nothing to do with your company. All right. If you do it in your paper, if you're talking about the expected earnings growth of your company, you've messed up. You'll lose a lot of points. We're talking about the expected return of the stock market. All right. The market risk premium has absolutely nothing to do with your company. Your company comes down to beta. So what type of company is it? What is its operating leverage? What is the financial leverage? And what's the history of the beta? All right. So I'm doing Walmart. This is definitely a defensive company. Discount store selling discounted products plus large grocery operation. So there is just your opinion. What kind of firm is it? Some firms are a little trickier than others, but Walmart is beyond a doubt a defensive company. I think it was the only stock in the S&P 500 that was positive in 2008. So definitely a defensive. So you just have to talk about that, defensive or cyclical. Step 2 is operating leverage. So here you have a couple of things you want to talk about. First is the subjective. Fixed costs, the cost structure. That's what operating leverage is. So operating leverage is asking, is this a firm with a lot of fixed costs, which makes them really, really volatile and really risky, or is a lot of variable costs? So for Walmart, their fixed costs for your stores, and depreciation, but the variable cost is an hourly workforce and stable gross margins. So I would say overall low operating leverage. But then there's the mathematical part of it, which is really not mathematical, but it gives you some indication. So evidence to support this. So let's look at the volatility of margins. And that's an Excel spreadsheet that you can use. I will update this spreadsheet eventually. I was kind of waiting to make sure I had 2024. I can't remember where I put it last. I have it out there somewhere. I'll have to find it. I don't think I put it on canvas yet because I thought I could update it. It takes me a while to update it because it's such a massive amount of information, but let's see if I have fun put it out there. Yeah, let me find it from last semester. You had me before, you've seen this spreadsheet before as well. All right, it'll be in here. So I'll get this file out to you once I update it. I think I did it. It's really, I got 2023 data in it because I couldn't get an update last year from it. All right, so when you bring up this file, the first thing you want to do is go to the second sheet and find your company, Walmart, and see what line it's on, 2910. And then you come back here to the green and you change that to 2910. That brings up your company. You got all your data. So for margins, what we're looking at, be real careful when you talk about this chart. We're looking at this chart. These numbers are not the gross and net margins of the stock market, all are of Walmart. These are the standard deviations of their margins. All right, be real careful when you're at your paper. So my theory is firms with high operating leverage with high fixed costs are going to have more volatile margins. And I would focus on the net margin. You could actually leave the gross margin out entirely if you wanted to. So the net margin for the S&P 500, the median standard deviation, not the median margin, but the median standard deviation is 7.46%. Walmart's is 0.73%. So they're a very, very, very stable firm, which supports that they have very low operating margin. Firms with high fixed costs are going to see their margins more volatile. Why? Because if you have fixed costs, if revenues fall, your expenses don't fall, and your net income is going to fall a whole lot more. Same thing on the upside. Revenues rise, your expenses don't rise, so your income rises a lot more. So that's my argument. Walmart has very low operating leverage, and you can notice it in that they have extremely stable margins. All right. Don't leave out the subjective part. So if you're doing NVIDIA, yeah, they got a high paid salaried employee base. That's going to give them some high fixed costs. If you're looking at Intel has this massive property, plant, and equipment. It's going to give them a lot of fixed costs through depreciation. So those kind of things you want to think about in your answer. It can get tricky because you might be surprised. You would think Ford has really high volatility of margins. They do have a lot of fixed costs. But with Ford, it gets tricky because a big part of Ford is Ford Motor Credit, which is more of a bank than an auto manufacturer, and banks tend to have very stable net interest margins. So you can be surprised. Ford's a tough company to do because it does have a large credit arm. They do almost look more like a bank than they look like an auto manufacturer. So it can get a little tricky. You might get this chart first before you do your subjective part, so you can make sure you're kind of consistent throughout. All right. So Walmart, definitely defensive, low operating margins. So we're arguing low beta. So low beta, still low beta. Oh no, I just did that thing. Oh, how do I undo that? Where is that language? Y'all see it? I don't know what key I hit, but there should be like the loudest. Any of y'all speak Russian in here or read Russian? Now the key on margin on leverage, your firm's number one is the most important part. What kind of firm is it? So operating leverage and financial leverage is not going to change it from a 0.5 to a 2.7. So think about steps 2 and 3 pushing you closer to the 1 or further away from 1, but not radically changing it. So Walmart's not going to go from 0.5 to 1.7 because they have high volatility margins. Now here, both of them support a low beta, so we've got that. But if they have high debt, and we'll see, I mean, Kroger's is a good example. Kroger's has a very low beta because it's defensive, but it does have high debt. That's not going to take them from 0.5 to 2.5. It's going to take them like from 0.5 to 0.7 or something like that. So it has some impact, but it's not massive. And then step 3 is financial leverage. This one's probably the easiest one of all, because there you just need the chart. And you can see their debt to equity is in line with the market. So here I'm going to say no impact from beta. It's somewhat neutral. If they have high debt, it's going to push their beta up closer to 1. If they have low debt, it'll probably keep it down there pretty low. There's probably no impact. Now, if you pick a firm, and there's a lot of them, you'd be surprised. Let me show you, where are we here? Some of y'all might want to do McDonald's. What is McDonald's debt to equity? What's their equity? They're bankrupt. They have negative equity. Their assets are smaller than their liabilities. You can't do a debt to equity. So if you want to do a McDonald's, we can still do it, but instead of debt to equity, I have to redo the whole chart and do debt to assets so you can compare it to the rest of the industry. So I can do debt to assets. So if you find a firm that doesn't have equity, email me and maybe I'll just create the debt to assets chart, and you can still see if their debt is high versus other companies. It's not just them, there's others. I mean, it really is pretty amazing. There's Starbucks. Is Starbucks bankrupt? Peter Piper Pizza. I don't know how to do it. Is it just pizza? Papa John's, maybe. Here's Papa John's. What's with the restaurant industry? They all have negative net worth. It's really bizarre. There's some that have negative net worth for very good reasons. So there's Boeing. Boeing has negative net worth because it's a failing company. So theirs isn't because they're buying their stock back. It looks like they've issued some equity here recently, but look at that, negative $17 billion. It's like, do we even care about the accountants? The firm's bankrupt, right? I mean, isn't the definition of bankruptcy? You have more liabilities than assets, and yet it's a going company. So if your firm has negative equity, you're going to get an NA here. Don't panic. You'll have to just use the debt to assets chart and say, because they're not going to have negative assets for sure. There are some firms that just don't have any debt. Lululemon is kind of that firm just doesn't like debt, and so then they'll just be ranked #1 because they just don't have any debt. Right. And then the last one is history. And here what you're going to do is a rolling 5-year monthly beta. And I'll do that. Here's where you can have a problem because Yahoo Finance, we'll see if we can even do it in Yahoo Finance. I do have a file where you can do it in Bloomberg. So if you have a Bloomberg account, the file I created, you can do it in Bloomberg in a nanosecond. It's all set up. Let's see if I can even do it. It's really, really tricky. So you do historical data. You want monthly. Make sure, let me just warn you, make sure you click monthly here before you do max here. On my machine, if I do max and do monthly, it takes forever because I have to do daily prices back all those years. Now let's see if it'll work. You're now just going to copy it all the way down. We're not going to use all of this because oh, come on. It's not letting me copy. I don't know if it will let me copy or not. Yahoo Finances. For some reason, they want to make money. And so they're making it really hard to use your data. All right, we got the data. So what do we need? We need the date. We need the closing price. So you can delete this, delete everything else. The other problem I have, we have dividends in there. So what I do is I sort the whole thing by that second column. Go down to the end and get rid of all the dividend dates and then just sort it again. Now, one thing you'll notice, this is something Yahoo has messed up. Walmart stock was not 1 penny in 1972, but they've had so many stock splits that it rounds to 1 penny. So these are, it used to be Yahoo Finance, this wouldn't be 1 penny, it'd be 1.01236755 all the way out. So you can actually calculate a return, but you can't calculate a return if it's 1 penny, 1 penny, because what's the return? It's 0%, 0%, 0%, 0%. So you can't use that. So what we're going to have to do is I usually make sure it's at least above $1 before I'll start using those historical numbers. Let's go back to, we can go back to 19. We don't have to go back all that far. We'll start in the 90s. I may not be able to finish this before he gets here. So there's Walmart. What else do we need for a beta? We need the S&P 500. This one may be trickier because this is where I've really had trouble, but use the GSPC. Again, you want monthly. And here we're going back to 12/31/1989. Let's see if it let me copy. It was not letting me copy it before, and it looks like it's not going to let me copy it again. Yeah, I can't copy. Yeah, they fixed it. And try SPX and see if that will work. Probably not. Yeah, SPX works. I'll just warn you, SPX, just make sure you've got the right one. So the SPX looks like it will let me copy it. So monthly, you can go back to 12/31 or whatever year you're doing. And you copy it. Copy function is not working. And sort it. It didn't bring in 1989, so I don't have that one. And we just need last column. Make sure your dates are lined up. So we got January. April hasn't ended yet, so I'm going to take April out as well. Now it gets real tricky. Notice it says March 1st. It can be really, really tricky to know exactly what month this is. I'm going to go back and look at Walmart and see what their price was. I can tell y'all, so March 31st, that's not Walmart. So March 31st was 87.79. Yeah, so I think this March is March 31st, so I'm going to delete these. So you just have to get the data lined up. Once you get the data lined up, you got it made. The easier way to do this, let me just assure you, is to use the Bloomberg file I have set up. I'll put it out there. It's already got you have to just put the ticker of your company in. The S&P is already set up and everything's already lined up monthly for you, so you don't have to do all of this. And then all you do is you get the return for Walmart. You get the return for the S&P. And then we're going to do a 5-year rolling. So you find month 60. Then you do the slope function, equals slope. You do your company, make sure you do your company first, then the market, and you'll be surprised that their beta was above 1 when they started. But I'll show you how I'll handle that. So there's my beta for Walmart, 0.68, which is kind of high for Walmart here recently. You can go back to Yahoo Finance and make sure you're in the ballpark. They say it's 0.69. I have 0.68. Why could it be slightly different? It should be the same. Your very, very last beta, because we're doing rolling 5 years, your very, very last beta should be what's in Yahoo Finance, because they're doing 5 years, 5 monthly, last 5 years. This is monthly last 5 years. Why could it be different? It's possible that they're using those April numbers and I didn't, so it's possible they're including that. It's possible they're using closing price and I'm using adjusting close price. So there's a few things that could cause a slight difference, but you shouldn't be radically off. It should be pretty close. All right. Now for Walmart, this period of time, this might not be true for your firm, but I'm going to say Walmart became a different company in say in 2004 or something. So I'm going to do the median from 2004, the 10% from 2004, and the 90th percent from 2004. So equal median. Let's go find 2004. And then I'm going to do the percentile, comma 1, comma 0.1, and percentile 0.9. So they've ranged 80% of the time between 0.2 and 0.58. So when I graph all of that, and we'll do this again next class too to give you some practice. It's there. Make sure you put the dates in there. Very important. The label low. The number you only need years. Now you can see why I did it from 2004 because it was a really different company back here. So if you see a company where it's really high, but the last 20 years has been really low, I would do your median and your percentiles from the new period. Because if I did the whole period, it'd be too high. So you can see Walmart's been in this range for the last several years. That 0.68, see what I say about that 0.68? It's a little wild. Why did it jump up all of a sudden? Probably because it fell so much in March. But gives you some sense. All right, so beta range. You can kind of look at the chart. They've been ranging between 0.2 and 0.6. And what I strongly recommend, let's see if I have time to this. So you have your beta summary. I would strongly recommend when you finish all of this, you have a table that lists those four things. You got the revenue sensitivity, definitely defensive, beta, say a 0.45, op leverage, low fixed cost, 0.4 to 0.5, 0.45, financial leverage, inline debt, 0.45 to 0.5, history, well below 1 since 2004, 0.3 to 0.5, final beta, we're going to use 0.45, something like that. All right. The reason you put that at the end is what some students do. I mean, in fact, a lot of students do this. Is after doing all four steps, step 1, 2, 3, 4, their beta entirely comes out of the chart. It's as if they never did steps 1, 2, and 3. And if you don't reference back to steps 1, 2, and 3, you don't get credit for, you lose a lot of credit. So one way to make sure you reference back to steps 1, 2, and 3 is to put a table there that you summarize it all. So you can say, hey, my final beta for Walmart is 0.45. And looks like we got 2 minutes. So then we say my discount rate. It's going to be the risk-free rate plus market risk premium beta. So discount rate equals the risk-free rate plus market risk premium times beta. So my risk-free rate was whatever it was, 4.4%. My market risk premium, I can't find it now, 3.38. My beta, 0.45. So my discount rate, risk-free rate plus market risk premium times beta. And go out 2 decimal places. Reasonable here, it's going to be 5.5% to maybe, I don't know, maybe 15%. That's a little high. Maybe 12%. It's rare that you can get above 10% in this environment. You don't see a lot of stocks with 10%, 11% discount rates. So for a high beta stock, maybe you're 8 or 9%. For low beta stock, maybe you're 5 to 6. Don't go below 5 because remember, you're going to take your discount rate minus your growth rate, and that has to be a positive number. So if your discount rate's 4%, your growth rate can't be more than 4%. It can't even be close to 4%. So you're really limiting yourself. Y'all see now why I added up 1.5% for the stock buybacks? Because if I hadn't done that, my discount rate gets really, really, really low. So, and it's much bigger impact, obviously, for high beta stocks. For lower beta stocks, and less of an impact. But at least adding that 1.5%, if your beta is above 1, it's going to give you a decent discount rate. That essentially, I know we did it fast, but that essentially is your paper 3. Now, if you didn't follow all of that, I have a video that does this entire thing again. It's a little dated, so the data will be from last year, and so I'm not going to redo that video, but you have it, and you can use it to go step by step. All right, questions on paper 3? That is paper 3. We got it. Don't do this by referencing the video over and over. Make sure you can do this off top of your head with no notes as well. Because if you walk into a job, I know it seems so easy in college because your professor gives you all of this stuff on the exam. Here's the risk-free rate, here's their beta, here's market risk premium, what's their discount rate. You go, wow, finance is really easy. But how much are they going to pay you, do you think, to plug those 3 numbers into a formula? Couldn't you teach your 7-year-old nephew to do that? Probably. They're not going to pay you much. What are they paying you for? Come up with these numbers. And is your employer going to sit down and show you how to do that step by step? They're going to assume you already know how to do that. So this paper 3 is a good test to know see if you know finance, because your first job is going to assume you can do this, that you don't need any help, any instruction, you just do it yourself. So it's a good practice. So don't do it just for this paper. Make sure when you're doing it, you say, yeah, I can do this on my own without any instruction. I mean, you can always reference back to it if you need to, need help. But all right, so let's start talking. I'm hoping he'll come in here pretty soon. So where do we go after this one? The next part of it is the valuation. You have to use 2 models, and I showed those to you up above. So you have to use these 2. I used to do 3 models, but I only have 2 now because one of them. You ready? All right, so good. So we'll handle this on Wednesday. After Wednesday, you should be full ready to do papers 3 and 4. All you got to do is pick which company. How many think you'll do what you did on paper 2? Does that make sense? Because you already did a lot of research on paper 2. So you might do that. Double check it. We'll talk on Wednesday. There's some companies, like if they have had earnings in 20 years, it's going to be hard to do a valuation on them. There's a few things we already talked about. If they have negative net worth, we can't get around that. I would say you probably like Dutch Brothers. How long have they been around? 2020? Yeah, so you probably want at least 10 years, so that one might be a little tough. We can see there is a trick we can do that works really well where you can use like a proxy company. And so if you're interested, like if you want to do Dutch Brothers, come meet with me and I can show you can do a proxy company and graft them both together and give you some support for that. So like using a Starbucks with Dutch Brothers, and Starbucks gives a longer history and Dutch Brothers is shorter. So you can do that and get some decent data. All right, we'll stop it there. Dr. Agarwal wants to talk to y'all. So I'll turn it over to you. 2% day, that's a big day, right? And then interest rates, not a huge day on interest rates. 10 years falling back down, a little bit lower level. I'll talk today. Essentially, he's saying it's going to be data dependent. I mean, you can tell if he's wondering how tariffs are going to feed through on this. We had good retail sales today. I don't know if y'all saw that. So all this negative numbers on consumer confidence isn't coming through. Oh, how did that go off? I let it go off. I don't understand this computer at all. Oh, great. Why is it? I don't understand. All right. Oh, I don't know how I hit that. I didn't mean to hit that. All right. Sorry. Oh, retail sales are strong, but I don't think anyone cares because all this data we're getting is pre-tariff data. And we really don't know what's going on with tariffs. And I hate the word tariff because it sounds like I'm saying terrorist. So the other day, a student was talking about tariffs impact on bonds, and it's not like he's talking about terrorists and bombs. It's like, what are you talking about? So my brain takes an extra 4 seconds to say, what are you talking about? Apple's down. The Magnificent Seven. Just I don't know. Did y'all see Nvidia today? It was down the most of all the S&P stocks. It actually recovered some there at the end, but yeah, just I think it was down more than that, but yeah, that's kind of strange. But yeah, a huge day. It's going to be like this for a while. So we saw the VIX fall quite a bit. It's probably back up there above 30 again. So the VIX has been high. Yeah, so it's an interesting time for stocks. We were looking in our dashboard team. I'm a little bit interested in Target right now because Target is down so much and it's a really, really cheap stock. they're, and we'll talk about this. So after we talk about valuing stocks, we'll talk about relative value analysis. But they're trading at on EV to sales of 0.54. Costco's at 1.6, Walmart's at 1.5, so they're really, really cheap. So why is Target so much? And we're talking dashboard team. Who should be cheaper, Costco or on an EV to sales? So who has the higher margins, Costco or Target? Target. Whoever has the highest margins should have the highest EV to sales. Who has the highest EV to sales? Costco. So that's why I don't own Costco, but do y'all shop at Target? No, do you?
There's apparently like a boycott going on.
Oh, is there related to what?
They got a lot of their corporate donations from like Israeli backed
Okay.
hacks, I think. So
I haven't seen that like on Facebook or someplace, but oh, that's interesting. Well, that tends to be temporary, but we'll see. It could be longer term. Well, I'll have to look in, but from a valuation standpoint, it's a much, much, much cheaper stock than these others. So anyway, it's interesting. We were looking at the stocks that were down the most this year, and there are some really heftily down stocks this year that are pretty interesting. All right, let's talk about valuation. So we're working through the valuation. Last class we did the beta for Walmart. I can't remember where I graphed it, but somewhere in here there's a graph. I don't know where the graph went. Somewhere there's a graph. Oh, I put it back over here. I did a little, when I did the median and the 90%, I decided to start that from 04 because this is when Walmart was a much smaller firm. So I want to show it here. If you do Dutch Brothers, it's a little tough. So what I did with Dutch Brothers is I did Starbucks rolling beta, and I did Dutch Brothers for what I had. You can see they're way, way up there. That much data. So what you can do is let Starbucks be your proxy company, and you might, because they're smaller, you might add a little bit to them. Then they're going to trade. Smaller companies will have higher betas, so maybe add 0.5, make them a 2 or something like that. But you can definitely use Starbucks. To get this graph to work, I didn't use 5-year rolling betas. I did 3 years. So I can have, if I did 5-year, I wouldn't have even one dot for Dutch Brothers. So it is a challenge, but you can get around it with a proxy company. Sometimes it works really well. I saw the other day we're looking at Ford and Tesla and Rivian. So Tesla has a lot of history, Rivian doesn't. And you look at Rivian, it's like, looks at Tesla, it's like this. But the period of time where they have the same data, they're right on top of each other. So it gives you some confidence that Tesla is a good proxy for Rivian. You don't get that with Dutch Brothers because there's just not enough data. And look at their numbers. 62% minus 19%. You're up 62, that's why their beta is so high. They're up 62% and the market's up 6. They're down 22 and the market's down 6. These are just down 15. These are just massive, massive numbers because it's a small firm starting out. So, if I were doing, I don't know if Travis, you were going to do Dutch Brothers or who was over here was going to do, but if I did them, I would probably show the Starbucks chart, and then you could even show this, the few that they have, and just say they should eventually look a lot like Starbucks. But they're a smaller company. I'm going to push their beta up to 2. You could use that kind of just subjective logic. Betas are subjective numbers. UT Austin doesn't know that, but they are. They're not numbers you look up in Yahoo Finance. They're numbers that you forecast just like you forecast growth and anything else. So you don't have to use the historical numbers. Most of your classes, your other classes do that I don't like at all, is they just graph the 2 returns and they do an XY chart. Have y'all seen those in the other classes? Have y'all done that on beta? And then what do? You just put in the trend line, and the slope of the trend line is your beta. I don't like this at all because it's just a bunch of dots. So I prefer to see every 5, because this is what Yahoo Finance puts. Each one of these dots is what Yahoo Finance is showing, the latest 5 years. And so UT Austin, that's probably what they do is they just go to UT Finance and pick that up. If you go to Bloomberg, it's the same thing. You just can get the latest number. But you can see the latest number is very different than what it's been the last few years. So, I probably wouldn't use that number because it's 0.68 just seems way too high, given that they've been well below 0.6 most of this last period. So there is some subjectivity there. You do have to have this chart in your paper. So I'm requiring that. And then I'm recommending that you have a table at the end, just to prove that you thought through the whole thing. So last class, we got our discount rate, 5.92%. So now what we're going to do is valuation. And if you look at valuation, here's our formulas. So what we need is dividend 0 or free cash flow 0. We need long-term growth. We need short-term growth. And we need the H. So for paper 4, you don't need as many items. I'm going to recommend that you use free cash flow for sure, but I'll do it both ways. And I'll calculate free cash flow per share over here. I showed you that up above. We talked about it up here. I might be able to just copy it over. I'll copy it down so we have it again. So let's get dividends per share. So dividends is pretty simple. You can get this from Yahoo Finance. Many of your companies, that's going to be 0, so you can't use dividends per share. But for Walmart, we just find Walmart and you go to history, historical data, and then you just change it from prices to dividends, and you got it. You want the last 4 quarters, right? So 21 3 times and 24 1 time. And that's their dividend for the last year. So dividend 0 is what they paid over the last year. All right. I realize if you go to the summary, they show you a dividend. This number is just not a good number. So essentially what they do here, I think what they do here is they take the last dividend and multiply it by 4, although that doesn't quite look right. 0.24 times 4 is 96, not 94. But this is not a 4. A 4 dividend would be dividend 1. It's what they're going to pay the next 12 months, but that's not what they do. It's something different. Walmart's dividend is actually pretty easy to forecast. I mean, look at these numbers. 10 cents, 12 cents, 13 cents, 16 cents, 17 cents, 18 cents, 19 cents, 21 cents, 24 cents. It's pretty regularly they increase it 1, 2, 3 cents every year. So you can probably figure it out. It's pretty straightforward. So not a tough number to forecast. But I'm going to go with what they paid this last year, which is probably the best number to use. For some firms, Costco, I don't know if any of you are going to do Costco. I can't remember. I think 1 or 2 of y'all did Costco for your paper. Costco is a very bizarre firm in that they pay these massive dividends every few years. And how do you handle that? I would probably ignore that and just stick. Is anyone doing Costco in here? You are, so it's a little tough. There's a couple ways you could do it. You could just add up the last 4 quarters, or you could take this 15 and like say they do that every 10 years. So add an extra $1.50 on top of it, but you're probably better off doing free cash flow per share. My opinion is, and Costco doesn't talk about this. My opinion is for some reason they pay a special dividend instead of buying their stock back. So I almost view this as a stock repurchase more than a dividend, but they do it as a dividend. $15 on a $900 stock is a pretty hefty dividend. You know, 1%, 2% would be 18. So that's a pretty significant dividend all at one time. And they do them pretty regularly. $7. So it's a little bit of a challenge. But let's look at free cash flow. So remember, free cash flow is really the number you want. And you probably want to talk about this in your paper. So you might want to say, yeah, Walmart paid 87 cents per share in dividends this last year. However, I don't think that truly reflects the free cash flow of Walmart. Therefore, I'm going to use free cash flow per share. I would do something like that because you want to have that in your paper. When you were taught dividend discount model, use dividends. And I like what the Motorin says. That works for about 5% of the companies out there. For most companies, dividends is not a good proxy for free cash flow per share. We're going to use a really, really simplified formula for free cash flow per share. We're going to take cash from operations and subtract CapEx and then divide that by the number of shares outstanding. So real straightforward. So cash from operations for Walmart, you can get from the cash flow statement. On Yahoo Finance. Now, if you want to, you can go to Bloomberg and have Bloomberg. Bloomberg has a free cash flow per share for equity. You can actually use their number if you like. It's similar to what I'm doing here, but not exact. If I were you, also, I would not use the trailing 12 months. I would use the last year. So their operating cash flow is 36,443,000,000. Their CapEx, remember, it's under investing cash flows, and you're looking for that PP&E one. And that's 23,351. So their cash flow is cash from operations minus CapEx. So their free cash flow is 13 billion. We get their number of shares from the income statement. I usually use the fully diluted. So diluted average shares is 8,081. And so their free cash flow per share is their free cash flow divided by the number of shares, $1.62. So I'm arguing that $1.62 is much closer to their free cash flow per share than their dividends. Now, is it possible you'll find a firm whose dividends are larger than their free cash flow per share? Probably not on a long-term basis, but in any given year, it's certainly possible. You probably would have seen that with Costco if you had that year where they paid $15 in dividends. All right, questions on that? Did I go too fast? You'll see how I did that. Everybody see where I got these numbers? Now, if you went to Bloomberg, it might be $1.57 or $1.72. It's going to be in the ballpark, but it could be off. One other thing I'll warn you about here is volatility. So go to the cash flow statement. Let's do Dutch Brothers. So this might kick Dutch Brothers out. Let's see. So first of all, you have to have free cash flow per share. So their cash from operations is 246. And their PP&E. So they have some, right? That is a positive number, 246 minus 212. So it is positive. So you will have numbers there. But the other thing to be careful of is look back at the history. Dutch Brothers, you're probably okay using 2024. Let me show you Ford. Ford's a good example. Let's say you're sitting here right here with Ford. There's their cash from operations, but 2022 was a really horrible year for them. That's a more normal year there. I mean, which of these years stand out for you? I don't know what I just did there. Come on, come back. Boy, I'm doing all kinds of wonderful things today. I don't see. I don't know why it's not letting me see the row bar on the end. I don't even know how I got over there. But anyway, maybe do it from scratch. Maybe they'll let me. So the year that stands out is 2022. So if you're valuing forward right here, you don't want to use that number. So you might want to look over time and what we say. I did it again. There it is. I didn't have that before. Where did I? So Bill Gates is watching. So keep in mind, might need to what we call normalize. What normalize means is if the current year is really, really, really unusual, you might take the average of the last 3 years, the median of the last 3 years, you might find something that looks a little bit normal if you have a really bad year. Otherwise, you can get a really, really low valuation. All right. I don't think I need to normalize for Walmart, but I can look at it certainly and see it's possible, not that the current year is really low, it's possible the current year is really, really, really high. But Walmart looks okay. Why they want me to do that, but looks okay. It did jump from 2023 to 2024, probably because of all that inflation in 2022. But anyway, if I'm really worried about it, hey, the last 2 years, Walmart has been doing great the last couple of years, no question. You might say, well, that's not sustainable. I'm going to use the average of the last three. You have to decide. There's no rules on normalizing. Normalizing just means the most recent year is really unusual and then to somehow adjust to get that back to normal, whether that means you need to increase it or decrease it, either way. But that gives me a valuation. We'll use both valuations and see what it gives us on the valuations. But again, I don't want the column so wide. All right. All right, long-term growth rate. What do you think you're going to use there that we've already used? What might we tie their long-term growth rate of any company to? What do we do in paper 3? I remember in paper 3, this thing here, our growth for the economy, that would probably be a good number to use. We expect the economy to grow about 5%. So tied to economic growth in paper 3. Now, it doesn't have to be exactly the same. So I have some discussion here. I don't give full credit if all you do is just use the 5%. So you would probably say something in paper 3, I show that expect the economy to grow about 5%. Walmart is a very mature firm, very saturated in the United States. I don't think they're going to grow as fast as the US economy. So, going forward, they have some growth overseas. That's going to be more of the short-term growth, but ultimately they're going to grow with population growth and inflation. So I might use like a 4.5%, but you have that discussion. So I have some discussion in there. If you got a high tech company and you think, tech is always going to be in the forefront, the economy is growing at 5%. I think tech companies are going to probably grow a little faster than that, 5.5%. What you're not going to do is have the economy growing 5% and the long-term growth be 20% or 10%. That's just not possible. No firm can grow faster than the economy for a long period of time or they become the economy. So at some point, you've got to be a normal company. All right. Short-term growth. Let's talk about short-term growth. Any questions on that? So you're probably gonna have a number in the 3.5 to 5.5, 6% range. You're not gonna be too radically off. So short-term growth. There's a few options you have here. One is analyst expectations. So there's a couple of things here you can do. You can do the PEG ratio approach, or you can do Bloomberg EE function. Either those or both. You might even try both of those. So let's try with a PEG ratio. So the PEG ratio, we'll talk about that. The PEG ratio is the PE ratio divided by what analysts think growth is going to be over the next 5 years, which means you have analyst growth ratio in there. So if we bring in the PEG ratio and bring in the forward PE ratio, we can get expected short-term growth. Right? So we go to Walmart, all of these ratios are under statistics. PE ratios and all of those under statistics. The PEG ratio, again, I'm going to use the latest year for Walmart is 2.96. That's pretty high, kind of expensive. Their forward PE ratio, again, I'm going to use the latest year, not the current, is 35.59. So we know that the PE ratio divided by growth equals the PEG. So we know that 35.59 divided by growth equals 2.96. So 2.96 G equals 35.59. So G equals 35.59 divided by 2.96. So essentially the expected growth is going to be your PE ratio divided by your PEG. For Walmart, it's a big number, 12%. Pretty high growth rate. Going to look at an NVIDIA, which has a much lower PEG ratio today than it did yesterday. Their PEG ratio, look how cheap they are. You saw what Walmart was, 2.96. Look at NVIDIA. NVIDIA is one of the stocks we were long on because of their low PEG ratio. They're still very low, 0.86. There's people that believe PEG ratios below 1 are really cheap stocks. Would you think of NVIDIA as a really cheap stock? But because their expected growth rate is so high, they look like a cheap stock there. So 0.86, and their 4 PE is 28.09. And you do out the math, you still get a really high growth rate. So, very high growth. Why? Because, they're in the middle of the AI boom. So they're still expected to have really high growth. And they have had, I mean, it's kind of crazy even to look at it. They have had ridiculously high growth. I mean, look at this, isn't this insane? They went from $27 billion in revenue to $130 billion in 2 years. I mean, I don't know if I can think of another company. I mean, there's certainly, they've gone from 2 million to 13 million, but we're talking billions here, 27 billion to 130 billion. That's just crazy. So they're growing fast and they're expected to grow fast, but that would give you a high short-term growth rate. Your short-term growth rate can be very high. No question. As far as, let's get some Bloomberg here. So here's what Walmart has, what Bloomberg has for Walmart. So if you go into Bloomberg, you type WMT, the ticker, you hit the function 8, which tells you it's a stock, and you type EE, you get this chart, and then you change it. I didn't do it up here. I change it right here. Change it to annuals. And here you have a forecast for their earnings per share. So if you take this earnings per share here and divide it by earnings per share here and take it for 4 years, you'll get that annual growth rate. So you can actually use this same one. This looks like it's 375 versus 250, 2, 3, for 4 years. So 3.75 divided by 2.5 raised to the 1 divided by 4 minus 1. And that gives you a lower number, 10.67, but it's in the ballpark, right? So I just took the, where is that thing? There it is. So these aren't exact numbers, but this is 2029. So you start with the last year you have, well, here's the actual. So the actual is right at 250, and they're expecting 375. Now, it looks like 5 years, doesn't it? 1, 2, 3, 4, 5. But if you're doing growth rates, you need a base year. So you don't have 5 years, you only have 4 growth periods. You grow from there to there, that's 1, there to there, that's 2, there to there, that's 3, there to that's 4. So if you're looking at this year to that year, that's 5 years, but your N is 4. All right, everybody see that? And so that gives me a growth rate of 10.67%, real close to what the PEG ratios. Why are they different? Because they're different analysts, they're different forecasters, people have different sources, but they're in the ballpark. They're not radically off. You can also get a revenue forecast. You don't really need it for this paper, but you can look at their revenue forecast. So if you're actually doing a forecast, and we'll do this in my security analysis class in the fall, we'll definitely use Bloomberg's forecast to help give some insight there. If you're actually doing a forecast where you're actually building financial statements and forecasting them out, you probably want to do revenue and margins. And so you see what they have. They have earnings per share, revenue, net income. They have the operating profit, EBITDA. They have a few things that you can look at to give you some sense if your estimate is correct or not. All right. What else can you do? Well, you can look at history. So there's options here. You can do like rolling 3-year EPS growth. If I think about it, I'll do one of these. It's real easy to do this in Bloomberg. You just bring in their earnings per share and just do growth rates. You can do rolling 3 years, rolling 5 years, rolling 10. Let me show one quick way you can do this. How many of y'all have Capital IQ accounts? Just a couple of you. All right, so Capital IQ is not a bad one. Let me show it to you. So you really should, you want Bloomberg and Capital IQ on your resume. We'll definitely be using it in my security analysis class. So you go to databases. I may not be able to log in because I can't remember my login. Here's Capital IQ. Is you create an account. And when you create an account, as long as you log in with your UTSA account, what's the chances I remember my password is practically 0, but I'll try. Probably not going to work. Oh, wow. So if you get in here, you just type in your company, Walmart. So, and I'm not saying you might think about getting a Cap IQ account. I'm telling you, it would be really unwise not to have a Cap IQ account. And once you do this, it's a piece of cake. I usually click on the income statement, and then I take the year all the way back. And then there's a wonderful little button right here. It says download financials, which that downloads everything. And you click on that. It takes a little bit of time. You click on that and just brings in every single thing you possibly need. And then you can do rolling growth. I'll show you some rolling growth rates, or I'll show you some recent growth rates. That may not be a bad way of doing it. But it does take it a while to load. It's a lot of data. And the other place where you can use Cap IQ is they actually have an add-in where you can actually bring this data in on your computer at home. As long as it's not a Mac, you can bring it in, and it's really, really helpful to have that data. It's at your fingertips. That's a huge advantage of Capital IQ. You can use it from home, whereas Bloomberg, you have to be up here to use Bloomberg. All right, it's still working. So in the fall, the Investment Society, we're going to start this new society champion thing where we're going to have these big scholarships. If there'll be a list of 10 things, if you do like 5 or 6 of them, you get called a champion, and Capital IQ designation is one of those things that look wonderful on your resume. We're still developing that. And there's some really good videos on Capital IQ that are tutorial that the Corporate Finance Institute does. All right, it's still not opening up. I don't know if it's in maybe it's in my downloads. There it is. All right, so let's do the income statement. I'm going to hide all of these. I'm gonna put a freeze frame. So let's go down to earnings per share. Here's their earnings per share right here. So what I want to do is just look and see what is their 3-year growth, 5-year growth, and 10-year growth. So 3-year growth is going to be this year divided by, you have to go back not 3 years, but 4 years. Raise that to 1 divided by 3 minus 1. That's really strong. They have had a great year after a rough year a couple years ago. We do the 5 year, same thing. That divided by how many years back do I go? 6 years, so or 5 columns. Raised to the 1 divided by 5 minus 1. Doesn't look as strong. And then 10 years, we'll do this year and divide by, and then we do 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. And much weaker. So they've done really well recently. Okay, last 5 years, not so great last 10. But Cap IQ, just like that, just in a few minutes, you can have some really, really good data. So and then the last one is what you probably were taught in 3013, which is the sustainable growth rate. And again, you might need normalize. So sustainable growth, it says how fast can a firm grow without having to issue equity, have to borrow money? How fast can they grow on their own? And it's a real simple formula. It's just return on equity times 1 minus the payout rate. All of this is from Yahoo Finance Statistics. So it's really simple. We just need the ROE. We need a payout. The ROE is the one where you may need to normalize. If their last ROE is negative, or if it's ridiculously like 60% or something, you may need to go back and look a few years and see. Now, you can get it from Yahoo Finance or from Capital IQ. I just loaded Capital IQ, so I might as well use Capital IQ. So if we go into Capital IQ, we go under ratios. There's your ROE right there. Now the payout, we'll have to go find the payout. I don't know if they have payout on here or not. We can get it. We have, what is the payout ratio? Anybody know the formula for that? What did y'all top for payout ratio? Any guesses? Paying out what? Dividends per share divided by what? Well, earnings per share. Because what we're asking is, what percentage of your earnings are you paying out? That's the payout ratio. All right. So we can get this from here. So there's our dividends per share. There it is again. Earnings per share. Yeah, they have so many different ones that they're doing. Yeah, these may not be actual dividends per share as a percent, so I like that one. Yeah, it's not that one. So let's find their actual. So it's probably on the income statement. Let's see. So we found the earnings per share already. There's their earnings per share. Oh, here it is right there. Y'all see it? So it's on the income statement, line 78, payout ratio. That's what we're looking for, payout ratio. So I'll go back to the ratios. And I'll just bring this over, the payout ratio. And go get that from the income statement. 1979. So your sustainable growth rate is just going to be your return on equity. We'll start where I have numbers. It's going to be your return on equity times 1 minus your payout. And here's where I say you may need to normalize, because look at how wild these numbers are. So it was 5%, 1%, 12%, 10%, 9%, 7, 12, 15, kind of all over the place. I'll bring in the last 4 years. We can kind of decide. So what are you going to use? I don't know what number you might want to use, but find some number in there. If you look at the median over these last few years, Bill Gates. It's around 10%. It's not radically off what the analysts are saying. So in your paper, what you're going to say is, some number. You're going to come up with a number. Let's say 10%. So you'll reference those 3 approaches. The 3 approaches range from X to X. Recent growth has been 14%. Longer term has been much slower. Analysts are projecting somewhere between 10 and 12. Sustainable growth is somewhere around 10%. 10% sounds fine. So there's the numbers. So you got the numbers plus discussion. So where does the discussion come in? Why would Walmart be growing really, really fast here? So some of it might be growth in the US. How much growth, more growth in the US? So you could really get into this. You could certainly look at how many Walmarts there are in each state versus the population. So you might say, okay, there's I have no idea. It feels like 80,000 Walmarts in Texas, but I don't know how many are. But you can say, okay, there's 500 Walmarts in Texas, and Texas has 40 million people. So that's 1 Walmart per X number of people. In California, it's only 1 Walmart per X number of people. What if they grew so they had enough Walmarts to get California the same level as Texas, whatever? Certainly could do the same thing in Canada. I mean, with Costco. You could talk about international growth. They haven't done too well on that, except for Latin and Central America. I mean, South and Central America, they definitely have taken over. You certainly see, I haven't been to Mexico, but in Costa Rica, there's Walmarts everywhere. They just own that country. In South America, I don't know, maybe South America, y'all see Walmart, South America? PriceSmart's pretty good, aren't they? They're a pretty strong company and they have some dominance there, but Walmart hasn't done well in Europe. They haven't done well in India. They've struggled some. You could talk about curbside. That could certainly be a thing. I was reading an Economist article and they talked about ad revenue in business. And AI, that's to me kind of exciting. So Walmart, it sounds kind of freaky, but you walk into Walmart, they know what you've been searching on Facebook, and you're now walking down this aisle, they're going to send you a coupon and it's right there to your right. So would that freak you out or would that make you excited as a consumer? Does it bother you when you say out loud to a friend, I'm thinking about buying shoes and suddenly Facebook has shoe ads? Does that bother you? You think Google is listening to you or someone? Not only that, they're talking about you walk into the TV section and they know what you've been doing on Facebook and suddenly these advertisements come up related to what you've been searching. So Walmart may actually get into the ad business. How big is that going to be? It's hard to say, but there are certainly some issues there. There are certainly some efficiencies. So they haven't done it yet, but they've talked about eliminating their registers and their clerks that you just have you often seen the baskets, right? That you put it in a basket and it goes on your bill automatically. It just goes on your card. Now, Whole Foods tried that, right? And it didn't go so well. Amazon didn't go so well. Saturday Night Live has a really humorous sketch on that. But there's probably some efficiencies. It could be robotics, self-check, who knows? But what could Walmart do to either grow their revenues or reduce their expenses so that they can grow faster? You notice I'm not mentioning Sam's Club at all. Sam's Club is like an entirely different business. They can raise their member fees and other things, but it gets complicated. These are really tough businesses. I'm not asking you to make it perfect, but I would definitely say you have a good discussion in there. Where could they get? So AI is probably going to be a big deal for most firms. International growth could be. Costco is not really international at all. They're really US based. They could grow into Canada and some other places. So, think through those. But where could this firm have some extra growth? I forget the other thing with Walmart is now online with store pickup. That seems to be, I'm kind of shocked college students, 5 years ago, Walmart, we're not gonna go to Walmart. That's what my grandparents do. But now it's like, yeah, I can order it from Walmart and go pick it up on the way to school. I don't have to worry about Amazon delivering it to me. Amazon's gonna be a good 3 hours later. Might as well get it now. There's so many Walmarts that have that huge advantage of stores everywhere. I think 90% of the US lives within 10 minutes of a Walmart. So yeah, have any of y'all done that? Order online and go pick it up? So, you could talk home delivery, maybe. Some people are talking about drones. I think we're a ways from that, but we'll see. There's New York or some cities have it. It's not drones, but they're talking about drones, but they have the little robots rolling down the street delivering stuff. So there's stuff going on that could certainly help them. But those are kind of things. So that's just a discussion to tie where you got the short-term growth from. So you have numbers that give you some support, but then you come up with your own number. And then the H. So you're going to use the same numbers whether you're using dividends or free cash flow. We're just going to compare it. The H is where a lot of students get 0 credit. It's a real small part of the grade, so it doesn't hurt you that much. But essentially the H is asking if you're going to grow 10%, but eventually you're going to grow 4.5%, how many years is it going to take you before you're just growing 4.5%? And your H is half of that. So H half of time it takes to go from short-term growth to long-term growth. And again, it's just a discussion. So if you say there's growth in the United States, and you look and see, okay, where they're really saturated, everybody about these 7 states, but they'll be growing through these 7 states. Right now, they're adding about 10 stores. You can really do this with Costco. Costco adds about 50 stores a year. You can really see where they are in the United States. It's actually quite easy. Costco stores per state. And you can get the populations of each one of these states. So in Texas, there's 42. In California, there's 142. New York, there's only 19. So you could say, find the state where they're the most saturated. It looks like it might be California. Get California's population, divide it out, and say, if it takes 5 years for them to be as saturated in the United States as they are in California, what kind of growth rate is that? Pretty simple stuff to do. With Facebook, you can do almost the same thing with Facebook. You can look at how many Facebook accounts there are in the United States versus our population, and you can do that to India, you can do that in Africa, you can do that in China. They don't really have a presence in China. So you can do a very similar thing. Facebook, you don't pay Facebook any money, right, as a user, but Facebook's revenue is directly tied to how many active users they have. So you can look at how many active users they have in the United States versus US population. What if they get that saturation in Africa and Europe and other places? So there are ways you can base your assumption on whatever statistics you have, but ultimately it is a very subjective. So like with Walmart, let's say they're going to add, Costco, they're going to add 50 stores a year. And to be as saturated in the United States as they are in California, that means another 500 stores. Well, 50 stores a year and they need another 500, that sounds like 10 years. So sometimes it's really straightforward. But then you have the international growth on top of that. So this is what we call, y'all probably have heard of this, it's called creative writing. It's got to be rational, it's got to be logical, but there's no right or wrong. It's just you got to have some basis. Why do you think it's going to be 10 years or whatever? So have some rating. I'll say 8 years for Walmart. If I say 8 years for Walmart, then my H is 4. Your H is 1/2 of how many years that is. Okay. Once I have that, I'm almost done. So let's do our valuations. You got the Divinisc model, the H model. I gave you the formulas up above. So let's start with dividends. So dividend discount model, you do dividend 0 times 1 plus the growth rate divided by the KE minus the growth rate. That gives you a valuation of 63.98. We can do the same thing. I guess I could probably copy it over. I can do the same thing here, but instead of using dividends, I'll use the free cash flow. And obviously it's going to be higher by just the difference in those two numbers. So I should be able just to double check and see. It should be, yeah. So if I use free cash flow, I'm getting a much higher number. Let's do the H model next. Remember, the H model is the same formula again, but we're going to add in that special period. So use the dividend discount model again, and then you add in dividend 0 times H times growth long-term, short-term minus growth long-term. So we're going to do plus the dividend times H times short-term growth minus long-term growth. It gives me 77.45, and then we'll do the same thing here. Gives us 144.22. And then what is the current price? Where is my current price? Is 91.19. Make sure you put the current price in there. That's really important. So if I use dividend discount model, I'd probably not be recommending a buy on this stock because this is what I think it's worth, 63 to 77 bucks. and it costs 91. If I use free cash flow, I'd probably be putting a buy. So buy recommendation. And that's the end of your paper is the buy recommendation on the end. I have some students that get really weird at the end. Make sure this recommendation is all about your evaluations versus the current price. I have students that their valuation is really, really low, like 50 bucks, and the stock's trading for 200. And they say, I'm making a buy recommendation. It's a really good company. They're really growing fast. Well, no, you're not going to recommend a buy on a stock you think's worth 50 bucks if it costs 300 bucks. So make sure you reference these two. All right, we got some time here. I want to show you how can you make this much stronger. But we went through the whole process. You have another video that does the same thing. So we got the discount rate. Paper 3, we did our valuations here. In the paper, I'm probably not going to show these at all. I'm probably only going to show these. So what I probably do in the paper is just set it up. They pay dividends, like I think I said this before, they pay dividends of 87 cents. However, I think free cash flow is a better reflection. So just get off the stage doing that. One really important thing is throughout your paper, give me your formulas with the numbers. There are some students that have a real tough time with parentheses and they get really bizarre numbers. And I'm not really sure how they got their numbers. Some students make it really tough because they keep changing numbers. Their discount rate in paper 3 was 6%, but in paper 4, for some reason, they're using 6.3%. I'm like, where are these numbers coming from? They recommend a long-term growth of 5%, and then in the formula, they're using 6%. It's just really confusing. So make it really clear, go back and check. I think some students change things, but they forget to change it everywhere. And then I'm like really struggling to figure out how they got those numbers. And the reason I say that is this is really the give me points on the exam. It's just plugging your numbers into these formulas. You want to get 100% on that, but some students can't get 100% because I can't figure out where the numbers came from and what numbers they're using. So don't lose points on that because that's actually a big part of paper 4. All right, so what else could we do? So you could do a valuation table. So how would you do a valuation table? Well, I want to use beta and growth. So my betas, the beta I use for this firm was 0.5, but it looks like it could be as low as say 0.3, maybe as high. So I'm going to start with my highest beta. I might use say maybe 0.65. Well, the current one's in the last 5 years, so that's kind of the high end. Remember, our graph is a good way to get your range. So it's range from like 0.2 to 0.6. I might do, yeah, I'll do 0.7. And then I'll reduce that by 0.05 and go all the way down. I don't really like going down to 0.2, but I will. We'll see if we get decent numbers between that. And then on growth, my growth rate was 4.5%. But remember, they could just be growing with inflation, and population growth is pretty low. So I can start as low as 2%. And I might increase that by 0.25%. Let's go by 0.5%. There's no way they're going to grow at 6%. So I'm going to have some problems here because there's going to be a few places where my discount rate is going to be lower than my growth rate. So I'm going to have to watch that. But here we're going to value the stock. So the value of the stock, we have the free cash flow per share. I'm just going to bring it down so I can find it again. Of $1.62. The risk-free rate was 4.4. Market risk premium is 338. So I'm now going to value this stock. So I'm going to do equal dividend 1 times 1 plus the long-term growth rate divided by the risk-free rate plus the market risk premium times beta minus long-term growth. I'm going to plug this in on my numbers because I'm using 4.5%. I think I'm right there, aren't I? I'm using a growth rate of 4.5%. 4.5%. Probably should go a little higher than that. Well, we'll see. 4.5% and beta 0.45. So if I copy this over, maybe I did something wrong. So something didn't. What didn't I lock in a second? I didn't lock these up here. Let me lock these in. So the $1.62, that should be locked in. That must be locked in. That should be locked in. All right. So if I do that, what I like to do is go find the one that meets my assumptions. $1.1914 and 119.14. That's what it is. 119.14. So the one that has my assumption on it, right there. I'm going to change these columns. Got my betas. Growth rates. Make it look professional. You don't have to do this, but boy, it sure does make it look much, much more. It looks really good if you put it on LinkedIn. And I got my growth rate. And we can just copy this down and over. Now we will get some error messages. And so if you get some that are just crazy, like when you get a really low beta, you can just take that out or you can just block it out entirely. So what we're going to do here, our current price, I'll shorten this in some. We may not like that elsewhere in the. Our current price is 91.19. So what we can do in this table, make it really look good, is you can highlight this whole table and say conditional formatting, highlight cells. If our valuation is greater than the current price, is that good or bad? Do we like the stock? We love it, right? So green looks good. And then we'll say if it's less than a current price, make that red. And then our main range is right in here. And so we may actually not be saying that this is a buy. This might actually not be a buy. Why? Because my base case was way down here. So I might need to start this like at 2.5 or something. And then that gives me a little bit more. Then you're going to have to delete more. Obviously, if it's a negative number, take it out. This is where conditional formatting just really messes things up. So something like that. Don't show negative numbers. Don't show like $13 million or something crazy. Because remember, as your discount rate and the growth rate get close together, you get really exaggerated numbers. But something like this looks really, I'm not saying you have to do this, but I'd be really impressed if you did, but it also looks really good. If you put it on LinkedIn with a table like that. In my security analysis class, they're going to do a football chart. I doubt any of y'all would do it, but if you do, I'd be really, really impressed. I'll probably give you extra points if you do that. Have y'all seen a football chart before? Y'all done one before? Sebastian, you have? So that's the going thing. So something like this. So you have several models. We only have two models. That's kind of the problem. You can't really do a football chart well in here because you only have two models. But if you have multiple models, you get the range for your models, which is essentially those ranges in that. It's essentially the range in the square right here. Could be as low as 60, 78, could be as high as 156.33. You put that range in there. You look at the current price, look at the 52-week high and low and those kind of things. And you're looking for stocks that have more upside than downside. So football charts become really, really quite popular in a lot of these papers. So what models could you use? You've got two of them. You've got the dividend discount model and you've got the H model. There's also relative value models, which we use in my security analysis class. We're going to talk about relative value next. Those are pretty common. And then you combine the two. Let me show you when you combine the two. I don't know which company this is, FUBO, can't remember. But we'll use this model. One of the reasons you need to learn Bloomberg and Capital IQ is that Bloomberg and Capital IQ have so many Excel models for free that you can just load and use. This is one of them. This is the Capital IQ model. This one looks exactly like what investment bankers do. It's a really cool model. It's got a lot of stuff to it, but this is a pretty typical model where they forecast out 5 years. And then they use relative value analysis to get the value of the stock. So you can see here, they came up with the value of $6. The current price is $3. So it's trading really cheap to where it should be. So this is another. So those are the type of models you need. This is essentially investment bankers. They do 5 years or they discount 5 years and then they use relative value to get the out year. It's a pretty common model. The wonderful thing about Capital IQ, this isn't set up to do this because I copied and pasted values, a lot of the values. But all you have to do is change this ticker and the entire model updates itself. You don't have to do anything. Pretty powerful. Bloomberg has the same thing. Bloomberg has models. You just change the ticker and everything updates. These are the kind of things you want to be putting on your LinkedIn and in your resume. So powerful, powerful stuff. So I would be learning these things. If you want to really learn them in the fall, the Investment Society, you can join a sector team or join the security analysis class. What we're going to be doing is be looking at a lot of stocks and you got to move fast. So you have to have models that update really quickly. You can look at your assumptions and change them so that you can have that football chart. And let's say your stock screening model has 15 stocks. You got to get down from 15 stocks to 5 that you're going to actually buy pretty quickly. So you have to have these models so you can compare them. And you look at the football charts and say, that one's got the most opportunity, and you're going to do it. So these are the kind of things you want to learn. These are the kind of things you want to put on LinkedIn and be able to talk about it in an interview. I can't show you Cap IQ because it's not on this machine, but Cap IQ, when you click on it, it has a template button, and there must be 100 or so files in that template that you can pull in, and they're all linked. So all the work's been done for you. All you got to do is change. And on this one, actually, I marked the cells that you need to change. And there's only 6 cells you have to make changes in. And then you got a really good valuation model. So put these things on your resume, get them there. So if y'all want to put something like this in your paper, I would definitely give you some bonus points of putting some extra effort in. on it. It's not that difficult to do. Excel does have the data table. I don't like the data table. You can see I did a data table, but I didn't use the data table. The problem with the data table is it's really hard. Like you want to delete these bad values, it's really hard to delete them. It won't let you delete stuff in a data table. If you just build your table yourself by using the locking in function, you can get it to work pretty well for you. All right, any questions on that? That should give you everything to do 3 and 4. Does everybody know their company? I would start working on it because you don't have much else to do in this class until the final. I would start working on it this weekend. The first thing you got to make sure of is that you have good data. And the most difficult one is you got to make sure you have a positive number there. If you don't have positive free cash flow, you can't do evaluation. You can't value a firm that's negative number, you get a negative number. So I would start with that. Make sure you have a number you can work with for the valuation. If you have that, probably the rest of it will work. So, all right, I'll stop it there. We'll probably have team questions next week on stock valuation, and you'll see the video on that. It's not all of this. It's actually just plugging numbers into these formulas, which is very straightforward. There's also a question on how to come up with beta. I'll probably do that as a team question. We'll probably have 2 team questions, one on beta or one on CAPM and one on stock valuation.